You are focused not on 10-year, not on 2-year, but in the belly of the curve at 5 years. Why are you suggesting dynamics in the 5-year would be a more attractive place to be?
Sure. So I think it's all about how far you are from the first rate cut and where is the Fed going to cut those rates to. I still think we're about 6 months away from the first rate cut. In fact, the risks are that they don't even cut this year, they start to cut next year. They're so hyper focused on inflation, they are looking for a slowdown. So I think they might be a little late. But once they start to cut, we think they're going to cut a lot more than what's priced in. I mean, the market's pricing in what we're calling the trough rate, which is the end point of those cuts at 3%. I mean, 3% is actually higher than the Fed's estimate of neutral rate. So the market's not pricing in a recession, far from it. I think the market's pricing in normalization. If we actually do enter a recession, and in our view, it's going to be a recession, because of the bank lending standards, because of the lagged impact of rate hikes, as the consumer savings buffer runs out. And now we might even have fiscal drag. I think the only way to get a debt ceiling deal is to get that fiscal drag. So, as the economy slows down, I think the Fed's going to cut a lot more. But if the cuts are 6 months out, I think it's a little tricky to be in the very front end. But if you're too far out, then, there's essentially a lot of things that can move long end rates. I think that 5-year is sort of the sweet spot. 3-year, 5-year rates, I think those are actually very attractive because they're positioning for the Fed whenever they start to cut, just this idea that they're going to cut a lot.
Post-pause, whenever that is, where is the 10-year yield?
So I would say the 10-year is benefiting a little bit from the fact that there's significant inflows into bond mutual funds. Once the pause happens, I think we all look at what's next. I don't really buy the skip idea because the economy doesn't move, it's not that volatile. I think right now we're seeing the slowdown. As it starts to build up steam, I think it's going to lose momentum really fast. So I don't buy the skip and then re-hike. I think then we'll be all focused on when the rate cuts happen. I mean, we're looking at the 10-year below 3% by year end, at 2.5% by next year. So the 10-year will also have a significant move. I just like the 5-year a little bit more right now because it's more sensitive to economic data.